Right now, millions of married couples are making a retirement mistake that will cost the surviving spouse $150,000 or more in unnecessary taxes. The IRS calls it changing your filing status. I call it the widow's tax bomb, and it's ticking in 95% of retirement accounts right now. My client Margaret learned about it the hard way. 6 months after her husband died, her income dropped by $42,000, but her tax bill went up by $18,500. Here's the math that did it, and the 3 moves that stop it before someone you love gets hit. Margaret is 69. She and Tom saved $1.4 million over 40 years. They did everything the experts told them to do. Maxed out their 401ks, lived below their means, planned for a comfortable retirement. They were going to travel. Tom wanted to see Italy. Margaret had started learning Italian on Duolingo. 3 months later, she opened her first tax return as a widow. She called me sobbing. "I don't understand. We have less money coming in. How is my tax bill higher than when Tom was alive?" I looked at the numbers and felt my blood pressure spike. Her income dropped from $92,000 to $50,000. Her taxes went up from $8,200 to $11,500. The IRS didn't just take more of her money, they took it while she was grieving. And what made me furious is this was completely avoidable. When you're married, you file jointly. The IRS gives you wide tax brackets as a couple. When your spouse dies, you become single, and the IRS cuts those brackets in half. Think of it like this: you and your spouse share a lane on the highway. When one of you dies, the IRS doesn't keep your lane the same width. They cut it in half and charge you more to use less space. As a married couple, the first $89,000 was taxed at just 12%. As a single widow, only the first $44,000 is taxed at 12%. Everything above that jumps to 22% or higher. But here's where it gets cruel. Margaret still has that $1.4 million retirement account. And at age 73, the government forces her to start taking money out, about $52,000 per year. She doesn't want the money, she doesn't need the money, but she has to take it. That forced withdrawal pushes her into higher tax brackets and makes 85% of her Social Security taxable. And millions of couples are walking into this same trap right now. Now let me show you what smart planning looks like. David and Linda came to me when they were both 64. Same situation as Margaret and Tom, about $1.3 million saved, both retired, living on pensions and Social Security. Here's what we did. The Roth conversion window. While both spouses are alive, you're filing jointly, which means those wide tax brackets. We used that advantage. We converted $65,000 per year from their traditional IRA into a Roth IRA. Yes, they paid tax on the conversion, about $14,300 per year at the 22% rate. Linda asked me, "So we're paying taxes now instead of later?" "Exactly," I said. "You're paying $14,300 now at the couple's rate to avoid paying $40,000 later at the single filer's rate." Linda is now 72. Next year, when required withdrawals kick in, she'll only have to take out $22,000, not $52,000 like Margaret. Her tax bill is $4,800. Margaret's is $11,500. Linda saves $6,700 every single year for the rest of her life. Over 20 years, that's $134,000 that stays in her account instead of going to the IRS. At David's funeral, Linda told me, "I'm grateful he made us do this. It's like he's still protecting me." The taxable brokerage account. David and Linda kept $280,000 in a regular brokerage account, stocks and index funds. When David died, something powerful happened. It's called a step-up in basis. All the capital gains accumulated over 30 years were erased and reset to the value on the day he died. Linda now has $280,000 she can sell tax-free. Here's the framework that saved Linda, and, honestly, can save your spouse too. Bucket 1 is emergency and flexible cash in a brokerage account, about 1/4 of your savings. When your spouse dies, this money gets a tax reset. You can access it without increasing your tax bill, and there are no forced withdrawals. Bucket 2 is tax-free income in a Roth IRA, about 40% of savings. It's never taxed again, doesn't trigger Social Security taxes, and well, the government can't force you to take it out. Bucket 3 is traditional 401ks and IRAs, about 35%. This is what creates the tax bomb. Move money out of here while you're both alive so what's left creates manageable taxes, not catastrophic ones. Margaret and Tom had 95% in Bucket 3. That was the tax bomb. David and Linda had a 40, 35, 25 split. That was tax protection. When David died, Linda didn't inherit a tax problem. She inherited choices. Here's what to do in the next 48 hours. Tonight, go to ssa.gov, log in, and find your survivor benefits estimator. See what your spouse would actually receive if you died tomorrow. That number is your baseline. This weekend, pull out your retirement statements. Add up everything in traditional 401ks and IRAs. Multiply that number by 4%. That's roughly what the government will force the survivor to withdraw at age 73. If that number scares you, good. Next week, schedule a meeting. If you're between 55 and 72 and have over $500,000 in traditional retirement accounts, you have a Roth conversion window open right now. That window closes the day one of you dies. Find a fiduciary financial planner. Run the numbers. Start converting. Margaret wishes someone had told her this while Tom was alive. You're hearing it now. Linda acted on it. Margaret didn't know about it. Which outcome do you want for your spouse? I've created something I call the Widow's Tax Bomb Calculator. It's a simple spreadsheet. You enter your retirement balances, social security amounts, and ages. In 60 seconds, it shows exactly how much your spouse will pay in extra taxes if you die without fixing this. For most couples, that number is between $80,000 and $200,000 over the survivor's lifetime. It's free. The link is in the description. And if seeing that number makes you angry the way it made me angry when I ran it for Margaret, good. Use that anger to protect the person you love. If this helped you see your retirement accounts differently, share it with one couple who needs to run these numbers. The Roth conversion video that walks step by step through the math is right here. I'll see you in the next one.